Options, or at least some iteration of them, have been around for centuries. However, it wasn't until 1973 that the Chicago Board Options Exchange opened its doors and listed standardized contracts. The Securities and Exchange Commission, or SEC, provided approval for options cleared by OCC to be traded publicly and on a national exchange. By offering standardized terms, the exchanges removed the guesswork and uncertainty out of the options equation. When it comes to option contracts, the standardized terms are straightforward and include type, style, class and series, underlying security, unit of trade, exercise or strike price, and expiration date. Each of these terms will be discussed more thoroughly in the subsequent slides. Though learning about options may seem daunting to a beginner, when we break them down to their simplest form, there are only two types of options: calls and puts. And for much of our curriculum, we will be discussing exchange-listed equity calls and puts, meaning options that are based on underlying stocks or exchange-traded funds, also known as ETFs. Though we will discuss calls and puts in more detail later in this course, we should make clear the most fundamental concept of options. Buying a standard call option gives the owner the right, but not the obligation, to buy an underlying instrument, such as shares of stock, for a specific price within a specific period of time. Whereas selling that call obligates the seller to sell the underlying instrument at a specific price within a specific period of time. Puts function the opposite of calls. A standard put option buyer has the right, but not the obligation, to sell the underlying shares, and the put seller has the obligation to buy the shares, both at a specific price and within a specific time frame. Here is another view that might help to better illustrate the concept of standard calls and puts. Just as there are two types of options, there are also two option styles which dictate the timing of when the option buyer can request that the terms of the contract be fulfilled and when the seller can be expected to fulfill that obligation. Though neither term relates to actual geography, the two styles are referred to as American style and European style options. American style options can be exercised at any time up to the contract expiration date. This also infers that when selling these options, the investor can be assigned or called upon to fulfill their obligation at any time as well. European-style options are different in that they can only be exercised on the expiration date. An option class refers to options of the same type and style with the same underlying stock. So, in the example, American-style calls in XYZ would be considered the option class. The option series extends the class definition by adding an exercise strike price and an expiration. For example, American-style calls in XYZ with a January expiration and a $50 exercise strike price would be considered an option series. The options market is a reflection of the stock market. It is why the term derivatives is sometimes used when talking about options. Options derive their value from and are linked to an underlying financial instrument. In the case of equity options, they are linked to specific stocks which we refer to as the underlying security. For learning purposes, remember that in most cases, the price of an option, also known as its premium, will usually be related to movements in the value of the underlying security. When the underlying security moves up or down, call or put option prices fluctuate accordingly. For the purposes of this course, the unit of trade simply refers to the number of shares exchanged when and if the buyer chooses to exercise their contract. For standard equity option contracts, one option contract is equivalent to 100 shares of the underlying stock or an ETF. However, various corporate actions, such as mergers, stock splits, or special distributions, can modify the standard contract into a different deliverable, including a greater or lesser number of shares than the standard 100 shares. These options are commonly referred to as non-standard options with special settlement terms. If your option contract is affected by a corporate action, reach out to your broker or visit OCC's website for more information. The exercise price, or more commonly referred to as the strike price, is the per-share price at which the buyer has the right, or the seller has the obligation, to receive or deliver shares, assuming a standard 100-share contract. These prices and the intervals between them have been standardized by the exchanges according to their set policies. However, the exchanges also have the ability to adjust the intervals noted on this slide and offer more or fewer strikes and strike intervals as they see fit. Click on the video below to learn more.
There are some more terms you should know. The strike price, or exercise price, is the price per share at which the underlying stock will be bought or sold upon exercise of an equity option contract. If we're talking about a $50 strike, then that is the price at which you would exercise your option, even if the price in the marketplace has changed to, for example, $60 or another price per share.
As options are contracts, it stands to reason that, like most contracts, they have an expiration date. Simply put, the right of the buyer or the obligation of the seller only exists during the life of the contract, and up until the point at which the contract ceases to exist. This is known as the expiration or maturity date of the contract. Until recently, almost all equity contracts expired on the third Friday of the month. Today, however, exchanges offer a variety of expiration dates to meet investor demand, including weekly contracts which expire on any day other than the third Friday of the month. While most weekly contracts have contract specifications identical to their monthly counterparts, some weekly contracts may have noticeable differences, including last trading date and settlement value. As such, it is incumbent upon the investor to know the exact specifications of the contract before enacting an options trade. We should also note that while monthly contracts typically have a life cycle less than 9 months, there are options that have a maturity date of up to 2 years or more. Known as long-term equity anticipation securities, or LEAPs, these contracts often have the same specifications as their monthly counterparts, but may be leveraged in unique ways for a variety of strategies. Please take a moment to review some of the terms we have just discussed by clicking on the video below.
It's important to make the distinction between an option type, option style, option class, and an option series. Option type is the classification of an option as either a put or a call. Option style is the classification of an option as either American style or European style. Option class refers to all options of the same type, either calls or puts, same style, either American or European, covering the same underlying stock. For instance, all American-style calls on XYZ Corporation stock would be a class of options. Option series refers to all options of the same class having the same strike price, expiration date, and unit of trade. For example, all XYZ May 60 calls constitute an option series.
Let's take a moment to make sure that you have understood the standardized terms that we have covered so far. Match the terms on the left with the definitions on the right by dragging the terms to the appropriate definition. Thank you for taking the time to learn about options trading. If you are not fully comfortable with any of the previous concepts, please return to the module and review the appropriate material. In addition, any questions that you might have may be addressed to our investor services team at the contacts below. You may now exit this module and return to the main course menu to continue.